Past performance is no guarantee of future results. Any views or opinions expressed in this video do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you so much for taking the time to check out this video. Today I'm joined by Michael Kramer, who is known for reading the market here on Seeking Alpha. He also runs Mott Capital Management, and he's a frequent guest here across Seeking Alpha videos and podcasts alike. So I'm sure many of you already know who he is. Today, we're going to get a quick overview look of what he thinks is working in the market, what is not working, and what is to keep our eyes on going forward into this brand new year. Michael, it's great to have you back. How was the start of the year for you?
So far, so good. It's been a good start to the year, I think, for hopefully everybody, even though the market's been choppy, which I think creates lots of opportunities.
There's been a little bit of a wobble. I mean, everybody's watching gold and silver and seeing things going on in Iran, and Venezuela still has eyes on it. So there's a lot going on. And I know you always approach the macro markets with the overall look of scale of, looking at the places that people don't really want to pay attention to, whether that's currency markets, whether that's certain technical signals over the S&P 500 or NASDAQ or anything like that. So I'm excited to see what you brought us today. Why don't you go ahead and share your screen here so we can get into your presentation? And I know you have a legal disclaimer that we'll kind of throw up here on the screen as well for everybody, just so they're aware, specifically about, your views as well as using Bloomberg and everything else. So here you go, everybody. Take a second to read that if you don't mind. Pause the screen if you need to. And all right, Michael, walk me through it. What has gone right?
So yeah, I thought this was really fun to start with because we did a presentation with you back in August, and so I wanted to kind of like go through what we were talking about then and how things have played out to now, because I think it really all comes together and it's going to help us figure out where things may be going. The basics here is that what we were talking about back then was really about liquidity, and we were talking about how the negative liquidity we were going to be thinking about was going to potentially impact markets, and largely I think a lot of the things when it comes to liquidity have played out almost as expected, and I think really what you've seen is this really reflected in reserve balances held at the Fed. Back in August, they were talking about, we were talking about reserves being somewhere around 3.3 trillion, with the expectation that, as the Treasury started ramping up issuance again, that was going to have a negative impact and draw reserve balances down. And that's sure enough what has happened. We've seen reserves come down to about $3 trillion, which is a 10% decline. It actually helped to lead to the Fed starting that new quantitative program that they're doing where they're buying those $40 billion worth of bills a month. Basically, they don't want to see this number go any lower. And one of the reasons why they don't want to see the number go lower is simply because we've seen overnight lending rates really kind of creep higher. SOFR, which is the secured overnight financing rate, is sort of that important rate that helps to dictate and is set in the repo market, which is sort of the lubricating part of the market that makes sure all the money is flowing. And when that rate starts to rise, you can see conditions really start to tighten. And from August into September and October, we started to see those conditions really tightening. And the best way to measure the tightening of these conditions is by taking the SOFR rate, which is published every day by the New York Fed at 8 a.m., and then subtracting that number from the interest on reserve balances number, which is set by the Fed. And that spread basically tells us if conditions are tight or not. And what we can see is that conditions, even now, are still relatively tight compared to what they had been in 23 and most of 24. And you can see that basically right here with this rising, and we had these big spikes at the end of the months and end of the year. And if you take another look, another measure of this is by looking at the standing repo facility. We talked about how if there was stress that was going to become, if it was going to be developed, it was going to show up in the standing repo facility. And we've seen lots of volume trading through the standing repo facility. There's a lot of confusion that goes around with this. People will write on social media, oh, the Fed is injecting liquidity into the market. It's not really like that. Institutions are going to the Fed in search of liquidity to meet the demand they have for overnight funding. And the reason why they go to the Fed is because the Fed is offering at this point a better overnight borrowing rate. And this is all really like it's important stuff that I think people will overlook because as we saw in October and November, markets started to get really choppy. And really, if you look at where the S&P and the Nasdaq are today, they haven't really changed very much since the end of October. And we'll get into that in a few minutes. But again, here's another example. We've seen the VIX move higher. We've certainly seen periods and pockets of increased implied volatility in the equity market. And we've also seen the effect of what reduced liquidity in things like Bitcoin. I ran this chart through Friday, so it has moved up a little bit since then, but Bitcoin is down almost 30% from the period of the middle of October into the lows that we saw basically in late December. And so again, I think this really talks to the fact that we've seen liquidity get reduced, overnight funding markets have tightened, and it led to a couple of things, which is reduced liquidity has had a negative impact on risk assets. And more importantly, it's helped to lead the Fed to this new program they're doing. And essentially, like when I look at the market today, again, this was updated through Friday, we could say like, well, what's been off, right? And I kind of make this subjective, what's been off, because if you go back to the conversation we were having in August, we equated it this time period similar to that of 2018, 2019, meaning we could either see a decent sized drawdown in the marketplace, or we were going to see a period of lots of volatility, lots of choppiness. We haven't gotten the big drawdown. We certainly got about a 10% drawdown or so in the NASDAQ, but we have also really just seen the market trading sideways. I would say since the middle to the end of October, the NASDAQ hasn't even recaptured the previous uh, highs that it had at that point. And really, when you look at the S&P again, it's a very similar type of story. Just basically a market that's trading sideways with maybe more recently a little bit of a sideways upward bias. So I mean, from my viewpoint, the way that I'm looking at this market is it's kind of demonstrating a lot of the things we were talking about happening back in August.
So, looking at the correlation of all the things you're talking about here with the liquidity and the reverse repo and the injection by the Fed that to the banks themselves, how is this going to correlate to how the markets get treated going forward?
And I think that's really important, right? Because we all want to know what's going to happen next. And I think it's going to mean a couple of different things. First of all, Treasury is going to start issuing more Treasury bills again. And there's going to be a quarterly refunding announcement at the end of January. Ultimately, what I think this means for 2026 is going to be that we're going to continue to see tight liquidity conditions. We don't know who the new Fed chair is, and that's somewhat important because we don't know what kind of policies they're going to implement or what they're going to do with quantitative easing that they're not call, it's not QE again. But I think what we know, at least through April, is that the Fed is going to be providing just enough liquidity to keep reserves from going down, which means that once the Treasury starts to increase issuance again, we could very well start to see those overnight funding market strains return. And in fact, this week, the Treasury just started with those new issuances, increasing Treasury bills. And so the calm that we saw at the end of December, beginning of January, should be passing. And we really should start seeing those overnight rates rising. And we should also see the standing repo facility get used more. But also, what it may mean is that at some point this year, the Treasury may actually begin to issue more coupon debt. more of that long end debt that they've really been trying to avoid because right now with all the Treasury bills they're sucking out of the market that they're putting into the market, they're sucking lots of liquidity out of it as well. And so there's a good chance that by the time we get to the at the end of the month, that the Treasury not only increases its target from $850 billion to the TGA to $950 billion, but there's also a good chance that they really start giving the market better indications that at some point later this year, they're going to start doing more debt at the long end of the curve. And I think that that could mean that this little period of time where we've had lots of choppiness in the 10-year could give way to a 10-year that starts moving up towards 4.5% or so, if not higher.
So, Michael, can I
Um,
ask you though, real quick? So, for somebody
yeah.
that's listening to you, they may be wondering why does this specific area of reserves matter so much for the Fed? What would your answer to that be?
Well, it matters because we saw some of that strain in November and December. The markets were starting to get that stress was really starting to evolve. And when that liquidity in the overnight funding market begins to dry up, I mean, it affects everything from it basically affects the access in my mind to liquidity and leverage. And so I think it's really important because I think a lot of what's driven the market higher over the last 3 years or 4 years has been easy access to liquidity. And another function that we've seen more recently is that there's a lot of collateralization, not just of treasuries, but also of equities, because we've seen equity repo borrowing from New York primary dealers go up as well. So all of this stuff basically tells us that if we start seeing rates and pressures going up in the overnight funding market, it's really an indication that liquidity is tightening, and all this easy liquidity we've seen is not going to be here anymore. And I think that's really a reason why you've seen cryptos get smacked and why you've seen the S&P 500 basically go nowhere for the last couple of months. And I think it's going to eventually lead into the fact that you're going to see long end rates begin to rise as well, which was this 30-year chart I have in front of us. And I'm currently still thinking we're going to see a 30-year rate approach that 5% level or so. And ultimately, what I think that means is you're going to start seeing the yield curve really begin to steepen in a much more material way. Because at the end of the day, if the Fed is telling us right now, or the market for that matter, is looking at Fed fund futures as saying that the terminal rate on the overnight rate is around 3%, there's not really much room for the 3 month Treasury bill to go any lower. And so if you're going to see the yield curve re-steepen, it's going to have to mostly come from the back of the curve rising. And right now you can see that the 30-year minus the 3 month rate is only at 1.25%. And if you go back to 1988, it usually peaks at somewhere between 4 and 450 basis points. So there's still potential here that if I've written about this numerous times, that if you see a Fed funds rate or a 3 month Treasury bill bottom somewhere around 3%, it's possible that by the time this is all said and done, if we go through a normal steepening cycle, you could see a 30-year going towards 6 or 7%. And really, when you look at the 10-year minus the 3 month, it's a very similar setup where typically going back to the 1976, again, you can see that this has typically peaked somewhere around 400 basis points. So, I mean, even if you get to 200 basis points, 3 years, a 3 month at 3% implies a 10-year at 5%. And so you could start really imagining that rates at the back of the curve really can go much higher. And it may not really be a function of inflation or the economy. It just may be a function of the markets just repricing for what, typical and normal historical spreads are.
So, Michael, if yields are going up, what does this correlate for the various sectors and areas of the market?
Um, I mean, I think what we're going to see is more of a rotation in the market. And I think you're already starting to see that, right? I mean, you're seeing the ratio of the SPY to the RSP. The RSP is the equal weight S&P 500. So it's taking away all those weightings. So Nvidia in the RSP has the same weighting as UPS, right? Nvidia is no more important than UPS in the equal weight. And I think what you're seeing is already this rotation perhaps starting to take place. And you're actually been seeing it more recently in staples and things of that nature. And this is one of the indicators I like to look at because you can already see that we're very close to potentially breaking a support region, which would suggest that the SPY starts to underperform the RSP. In this chart, this is the XLK versus the SPY, and it's basically a measure of the technology sector versus the S&P. I mean, you can see that even right now, we're trading at the high seen in 1999 and 2000. And it kind of suggests that valuations are at those same types of extremes in some way, not necessarily all on multiple levels, but in terms of the ratio or the performance, how much it's outperformed the market overall. But I think that means that there are opportunities in other parts of the market. I recently did a podcast with Rena, and we were talking about that opportunity for rotation. This is healthcare versus the S&P. Just like the technology sector has outperformed, the healthcare sector has massively underperformed. And so there's could be lots of opportunities where healthcare does better over the course of this next year. And again, I think you have to selectively be able to go through these ETFs and maybe find the good from the bad to be able to find those values. What I like to do is I like to take an ETF when I find a sector that I think is really interesting. I'll take the ETF. I just look at the top 20 holdings. I start going through, I start looking at all the charts of them. If the chart looks interesting, I'll then go and check the fundamentals and start looking at the peers and everything, and then I might compare it to the options market. And I think that there are lots of opportunities out there like this still. Um, when you look at the XLE versus the SPY, it has massively underperformed the S&P 500 over the last couple of years, the energy sector. Certainly with this renewed interest in Venezuelan oil and possibilities of going into a take changing regime change in Iran. I mean, the administration's plan may be to get oil lower, but that doesn't mean the conflict and the turmoil in between doesn't push oil higher. And so, for full disclosure, I just bought Oxy for myself the other day, Occidental Petroleum, because it seems to me to be like a really nice way to play this. And, Warren Buffett being one of the largest shareholders, certainly, makes it to me at least a little more attractive. And so, I think there are lots of opportunities out there. Another sector that I've been looking at is the staples. The staples have massively underperformed. Now, the staples have actually started to rise a little bit. And I think basically what you're looking at is a market where, again, this is the XL. I think basically, and this goes back to the oil charts. So I think what I'm getting at here is that 2026 ultimately could be a year where you see that rotation really take place and that those easy periods of liquidity are essentially going to be no more. You don't have these easy liquidity conditions anymore. I think it's going to create a lot more churn in the market. I think that means you could see more volatility. I think the last 3 months may be a precursor of the next 3 to 6 months, just lots of back and forth. I don't know that we're going to establish a clear trend this year. I think that you could see a rotation continue. I mean, the software names, when you think about ServiceNow, Salesforce, all the Workday, those stocks have really been hit really hard recently, and they don't look any better when you look at them technically. And so it looks like that rotation is already starting to happen. And it could very well be that in 2026, these subsectors of the market may do better than technology.
Michael, this has been a lot to digest. So first off, thank you for putting the presentation together. Wanted to ask you though, I mean, we've seen price targets from the across the board, across all sorts of institutions, as well as Seeking Alpha analysts, where people are projecting the S&P 500 to go by end of the year. Would love to ask you, I know you say here more range bound, but we have people going all the way from 7,000 all the way to 8,000 for the S&P 500. You have any idea of like if you're considering range bound, are you talking about maybe 1-2% higher by year end, or or what should people be considering your view on that is?
The problem is that really, when you look at the construction of the market, if technology is going to underperform, it's quite possible that this is a year where the S&P actually finishes lower. It doesn't mean that we're going to 4,000, but what it could mean is that perhaps the S&P finishes somewhere in that 6,000 to 6,500 range, maybe even a 5,800 area, but that doesn't mean it's a bad year for the whole market. If Nvidia starts heading lower for some reason, or you continue to see the pain in names like Meta and Oracle, or this earnings season comes through and you really start seeing worries about CapEx spending, those seven or eight stocks alone, 10 stocks alone, could be enough to push the index down 7 to 10%, and the other parts of the market do really well. And I think that's really potentially the big confusion, right? Is that we could be range bound within the ranges we've already established earlier this year. Maybe it's between 6,400 and 7,000. Maybe it's, like I said, maybe it's all the way down to 5,800. But again, I think to have another year like we've had for the last 3 or 4 is going to be harder because I don't think the backdrop is the same. You don't have the tech leadership, it doesn't seem like at this point in time, and I don't think you have that liquidity component. Now, mind you, I've been bearish for the last 3 years on the market. I've thought it's been overvalued and it's gone much higher than I would have expected. But, looking at it objectively, which is all I'm really trying to do when I consider the fundamentals and when I consider where I think rates are going, and the Fed cycle, it really kind of speaks to, a market that I think at best is not going to have the type of year that it's had the last three.
That's interesting. I would love to do one last follow up with you on. I've read and heard whispers amongst other places of since it's a midterm year, obviously that the administration is going to do everything in its power to try to support the market, right? Whether that's the Fed put, the Bessent put, the Trump put, whatever it might be. You're saying that probably may not even be a factor this year. Is it strictly going to come down to this tech valuation that kind of determines where the market goes?
Well, and that's sort of the tricky part, right? Is that it's quite possible again that the administration goes through and runs wider deficits, which it seems like they're going to do, and they're going to be really heavy pushing on helping to recover the economy, but it doesn't mean again that tech is going to be the leadership. In fact, if they are going to be trying to push the rest of the market, it means a couple of different things to me in terms of pushing the economy, running it hot, as they like to say on social media. That to me would mean wider deficits. It should suggest stronger growth. It really should suggest higher back rates at the back of the curve. It should also mean that the rest of the economy broadens out and the rest of the economy does better. And again, I think that really speaks to the idea of if they run it hot, maybe some of these underperforming groups actually start to see their growth revive. And the growth reviving is actually going to result in an offset to potentially a weaker technology year, if
No,
that makes sense to you.
yeah, it definitely does. Michael, let's go ahead and wrap it up there. It's been a great conversation here today. I can't wait to circle back with you later this year and see
Yeah,
how
I'd
it
love
plays
to.
out. I mean, we do this every once in a while. So really appreciate you taking the time, sharing your insights with everybody here on Seeking Alpha. Everybody, click the link beneath this video. Go follow Michael Kramer. Check out Reading the Markets here on Seeking Alpha. And we will see you here again in the next video. Oh, and if you have any questions for Michael, leave them down in the comments. Maybe he'll have some time he can answer those for you as well. Take care.